Boys and girls, ladies and gentlemen, and those that are non-binary, welcome to another episode of the Deep Q Cast. You have your irregular hosts, Robert Ridzak, Carlos Indejas, and Matt Reed. Importance is not in that order. Usually goes in the inverse order. The brains of the operation, Carlos and Matt. I'm just here for funny jokes and smiles. Try to keep the conversation light. It's great to have you boys on for another round. What's going on?
Man, just living the dream. I feel like this has been a series of unprecedented volatility and random craziness in crypto markets. So I'm excited to not talk too much about banking regulation and other shit, but I think we kind of have to address it a little bit, but hopefully not too much today.
What's going on though? I didn't see that. Something's going on in the banking world.
I mean, as far as I'm concerned, it's like just another Tuesday. I think all of us actually share one thing in common, which is at one point in time in our careers, we worked at Deutsche Bank. And I think that if you've ever worked at Deutsche Bank, banking crises, scandal, and, sanctions from regulators is just sort of like, whatever. That's a Tuesday.
It's funny, though, there is this Friday effect where no one wants to be caught with a signature or SVB style scenario where come Sunday they're liquidated by the regulators type of thing. So people just get out on the Friday day before. So yeah, I think a lot of those EU stocks have taken a bit of a pounding in the banking sector, just spilled into other equity markets too.
Deutsche Bank was trading down quite a bit, wasn't it?
Yeah, quite a few.
All of them. So it's like I was watching Bloomberg, and one of the headline was "Who's working this weekend?" We had some. I
was about to say when I was working at Deutsche Bank in like 2017 and 2018, we used to have like hours upon hours of speculation about which European banks would get consolidated into the other European bank. and the line of reasoning really kind of goes like this. In America, there are the big four, and they exist. They're all nationwide or global banks. In Europe, you've got the EU, but all of the countries hate each other mildly. And so you'd as a for instance, you'd never have the German regulator would never let BNP Paribas buy Deutsche Bank. So that's off the table. The best that you could possibly get are these national champions where, for example, like if SocGen went under, then BNP would buy it. Or if Credit Suisse went under, then UBS would buy it. And if Commerce went under, then Deutsche Bank would buy that. Like you end up with this like conglomeration of national champions, which basically leads you to something along the lines of like, which basically leads you with something along the lines of, an English national champion, a French national champion, a German national champion, a Swiss national champion, and then like the Italians and Spaniards can go fuck themselves because they don't really have a banking system. And then at some point in time, then those guys need to start consolidating. And like, how does that work? Because, obviously the French could never get along with anybody, and neither with the Germans and the Swiss. Maybe potentially like the Germans and the Swiss could get along. So you might see like a Deutsche Bank UBS merger after all the things sort of said and done. But I think this is the problem with the European zone at the moment, is that there's still a collection of independent countries that have violent histories with each other. And I think that you might find a lot of, ill will towards the concept of merging banks across countries and having like a true sort of like banking union in the European Union.
What are you talking about? There's no borders in the EU.
Yeah, it's one big Schengen zone where they just sit around and sing Kumbaya and hold each other's hands. Hold on. Did you say Did you say Schengen Bang or Schengen Bank?
I said Schengen Bang. There's so many different amazing ways. I just like the way it rolls off my tongue. A Schengen Bang.
Yeah. It's the bank of Ricky Bobby, Schengen Bank.
Yeah. but like a French, like with a French accent. That was amazing.
Just say that you like little tiny French pancakes.
Is there a second neck? Oh my God, guys! We also some news from the FOMC, huh?
Yeah, I think it's nice to be on the right side of that for sure. There was some uncertainty, but at the end of the day, I think we all kind of knew it was coming. The 25 basis point hike, and the question really is: are they going to just continue now? The market is not pricing that in. Like I think they're done. Fed, they gave a pretty powerful. Powell gave a very powerful hawkish statement at the end, saying, credit will tighten as a result of this, but I think the banking sector's by and large strong, so they're not that concerned about it, and therefore their main goal is inflation still. So, their dots were unchanged as well. So there's still another hike to come potentially next meeting. We'll see how much more this materializes in the sense of like the economy at large.
I think I agree with you on that. I think we had kind of talked about this, that Jerome Powell didn't have a lot of options, right? Like he had to do 25 to maintain credibility, because that's the only currency that he has right now. It's the only currency he hasn't debased at the moment is his own credibility. And the idea really is that we kind of joked around about, like, this is prison politics right now. Like, he had to come out and be hawkish. He had to come out swinging, or he was going to be forced to, grab the bond market's pocket. And, so, like, I think he really was in between a rock and a hard place. I think that the main difference now is just sort of like, okay, now what do you do going forward? And I think that you saw, Mark Carney at the, British Central Bank did 25 bips. Christiane Lagarde at the European Central Bank did 50 bips, which is totally fucking gangster. Just absolutely blew up Credit Suisse, and will probably do the same to Deutsche Bank or, Santander or some other like periphery European bank. And then obviously, Jerome Powell did 25. I think this is probably the last they're going to be able to get away with, because I do not believe for one second that things aren't going to continue to break. I think you're going to have those like global SIFIs in Europe that are breaking and will continue to break, and I think that you've got regional banks in the U.S. that are breaking and will continue to break, and so I think it was an opportunistic, like, out of solidarity to the message, let's get this one in. I would be shocked if they have the capability to continue doing this much longer. My personal view, though.
It's interesting because the market rallied right when they raised 50 basis points, so it was like a good sign. The market, in my view, it seemed like the market interpreted that as like a good sign, because it means that things aren't that bad.
The ECB, you mean?
Yeah, the ECB, exactly. Yeah, and then now it's like I was like, bank stocks are puking because of it.
Yeah, which is why I think they're going to have to reverse course at some point in time. So it's like, great, you did 50 basis points in Europe. Their next move is likely an emergency cut after having to bail out, several of their, SIFI global investment banks. Maybe I'm being overly bearish, but I think personally that like the market rallied because they wanted to buy the absolute bottom of, or rather that inflection point of the rate cycle.
Yeah, interesting to see. I would be shocked if they would continue with those hikes.
Yeah, I mean, because the other great thing about, and at least in the U.S. anyway, I'll stick to the U.S. So we're seeing a lot of credit tightening right now, and I think particularly, and we kind of touched on this last time, those regional banks were. Right, so let's say you park deposits at a regional bank. The regional bank is usually going to lend that out. You park money at Wells or B of A or JP. They have no incentive to lend that out. They're just going to park that at the Fed. So a banking crisis or a liquidity crisis like this that causes a massive movement of cash into the big four banks. I think we've also seen, I saw reports today that we had a $200 billion net inflow into money market accounts in the US over the last 2 weeks. That's massively deflationary because that's really just now getting parked into short-term US treasuries. So if anything, I mean, the Fed's job in terms of like curbing inflation actually just got a little bit easier because now what they need to do is sit and wait and let, the magic of the market kind of do a lot of the heavy lifting for them. So I would, not only because I think it's the right thing to do to help out regional banks, but also because, a run on the bank and liquidity crisis on these banks is naturally deflationary because it's not then getting lent out to small businesses, medium-sized businesses, consumers, et cetera. I think we're really, really, really going to start to see this. And in fact, it might even be that they've overdone it. And the next move, because all these things lag and take time to work through the system, is when we find it work through the system of like, oh shit, maybe we actually did overdo this and we need to turn on the printer again to get things started up.
Yeah. I always find this stuff fascinating because it's also a little bit of a push and pull, right? Like you have the backstopping of those regional banks is almost a form of quantitative easing, but you're also raising interest, which is like counterproductive to inflation. But the mere fact of us going through this, you have this de-risking that's happening that's also deflationary. So it's like there's so many different variables that are playing into the future outlook.
But even if you think about it, so what are the rules of this backstop, right? So your regional bank, you give them your underwater, securities at par. They give it back to you at OIS plus 10 basis points, which is roughly like 5%, right? Which means you've got to pay interest on that. And the only safe option for a bank when they do that is to then turn around and park that in like short-term treasuries. So like, they're injecting liquidity back into the market, and the liquidity is going straight back into U.S. Treasuries. And that's the only thing they can do to be liquid to cover reserves for deposits. So, I mean, like, it's technically a bailout, but it's like right pocket, left pocket bailout. And it's not injecting new liquidity into the market in terms of, like, increasing the velocity of money to go out and stimulate actual, like, spending and lending across, what we'd call the real economy. So I would actually say the backstop is more like, right pocket, left pocket, heaven forbid, because we said this was a no-no word last time, bailout.
My lesson, okay?
But
I'm still bruised.
Yeah, but the net beneficiary is straight back to the fucking treasury. So it's not like we're going to see a lot of stimulus from that in terms of like, people rolling around with excess cash to deploy.
Yeah. We'll see how that plans out. Want to jump into some of the fun legal news too before we head over to there's a sneak peek for all of our listeners and viewers out there. Matt Reed's going to go through a modeling and bottling portion at the back half of this, so I want to make sure there's enough time.
Is that just because I have a bottle? Is that?
Coinbase, they received a Wells notice, which basically means that they should hunker down and get ready for a fun tango dance with the SEC.
So I actually didn't read it. Did it say the specifics in terms of what products they're offering are under?
Here's the brilliant part about it. No.
That's like
going to slap you, but you don't know where or when.
But when it happens, you'll know. It will hurt. Yeah.
Did you ever watch that show How I Met Your Mother?
A little.
There's a running joke in the show called the slap bet, and the two main characters have a bet, and the rule of the slap bet is that at any point in time, the winner of the slap bet gets 5 slaps at their discretion, no forewarning. And and one of the greatest episodes is they basically the guy puts a timer and I was like, I'm going to slap you at this point in time, and the anticipation for the slap is the thing that's too much for him. So in some ways, I actually
that
feel
one
like
I have seen.
the Wells notice from the SEC to Coinbase is the slap bet. It's like, listen, we're gonna slap you exactly at this time. The anticipation of this should kill you. But like, actually, if we go into the actual details of it, Coinbase actually posted a blog post with their chief legal counsel. And by the way, like, Coinbase isn't some like fly-by-night firm that has like really shitty legal team. They've got a pretty fucking blockbuster legal team. You know, their head of legal, you know, has some experience doing some serious securities law at some white shoe law firms. So I doubt they're going to take this rolling over. But to borrow a phrase from the kids, Coinbase has receipts. And this actually kind of makes me a little happy. The story from the Coinbase side of the house is effectively, you know, the SEC approved us when we went public. Our business model has not changed. We sought out regulatory guidance from the SEC. We went so far as to actually, at our own expense, spend millions of dollars coming up with an outline of what we thought would be a pathway to registration with the SEC for tokens which we thought could be deemed as securities. Like, in that same period, we actually got a license from the CFTC, who was very workable for us, right, for things that we felt like were commodities. And despite attempting to meet with the SEC on numerous occasions, nothing happened. They gave us no guidance. They gave us no clarity. Even when we did all of the work to share with them our thoughts that we prepared at our own expense. And then suddenly, earlier in the year, they said, oh, by the way, we are shifting from this being a exercise where we're working with you to generate, you know, a pathway to registration, to being something where we're investigating you. And also, here's a Wells notice. When Coinbase asked them specifically, you know, which elements of our business are in violation and for what, and which things on our platform are unregistered securities, the SEC declined to mention them. So,
what would they do? Are they just still preparing themselves their legal documents or something? I don't understand why you wouldn't come forth
if I know. Like, this is the whole like craziness of the SEC's actions is they're going after people, but they're not. When they go after people, they're not even telling them why they're going after them. Like, you just did some stuff that's illegal, and you're selling unlicensed securities. What securities specifically, we don't know, but they are. Trust me, and we're going to go after you for them.
It's kind of like, I feel like it's like my mom sees me like as a child. Like, she kind of knows I did something, but she doesn't know what it is. She's like, I know what you did. Come on. Come on. Like, please.
Yeah. And you learn very quickly to deny because there ain't no way I'm fucking telling on myself.
I need to look into this now after the call, but just I get a feeling for how often it is for the SEC to issue a Wells notice and then not describe what it is that they are issuing the Wells notice for. I'm not sure how common practice that is.
I felt like with Kraken they told them that it was for their staking platform. I thought they did anyway. Maybe I'm just misremembering, but yeah, it seems very absurd to not give any indication of what. And that's why I asked, because I thought that's what I read, that they just kind of said, yeah, you got a Wells notice for offering securities, but then said nothing on what the products were, what the offering is, or anything. Which is
and that's the thing. Like,
ludicrous.
if the SEC were to say, by the way, you here's a Wells notice, and here's why. At a minimum, I would be like, that's actually kind of bullish for crypto because they're giving some regulatory guidance. Yeah. But to do this and say, we still can't tell you why, is just a gigantic fuck you. And all it really does is waste time. my main reason for saying it's only going to waste time is that if we look at the recent history of court cases in the United States where the SEC has done bullshit like this. So, for example, the courts have come down, or at least the comments from judges with regards to Grayscale Bitcoin Trust being denied for a spot ETF. The courts have basically said, why did you approve a spot futures ETF but not a spot ETF? That's inconsistent, and you have no basis for doing so. In the Voyager case, where the SEC tried to block Binance from acquiring the estate of Voyager, the court basically said, if you can't tell me why you're opposed to this, then how am I supposed to rule in your favor? Especially when this is going to make, the depositors in Voyager or something like 70% whole. Explain how you're protecting consumers by stopping the proposal to make them whole on their, on their deposits. And then you also have the Ripple case, where once again it seems, based on indications, that the court is siding with Ripple in terms of the tenets of the Howey test that the SEC claims that Ripple violated. So I think when the SEC does these things from a perspective of overreach to people that have the means to fight them in court, it generally means that, like, the rule of law in the United States is doing what the rule of law is supposed to do, which is, consider facts, evidence, and hold it up to a standard of the law. So I think a lot of people ask me, it's like, oh, Carlos, are you worried that the SEC is doing this shit? And I'm like, no, I'm not worried that the SEC is doing this shit, because ultimately they don't make the rules, right? They exist on the behalf of U.S. Congress. And in the absence of Congress passing a definitive, legislative, rule about how to interact with crypto, the SEC can't make rules. And if it tries to, legislate by enforcement, it'll go to the courts, and the courts will look at these, and they'll look at the actual precedent, and they'll develop new precedent as it regards to cryptocurrency. The only problem is it's going to take a fuckload of money, and it's going to take a fuckload of time. But fortunately, for the industry, Coinbase has a fuckload of money, and, it will just take time for us to get to the bottom of it.
Yeah, we'll see how. I'll be waiting with bated breath to see what details come about the Coinbase.
One other thing which is kind of cool is
Yeah.
Vitalik Buterin just yesterday came out with a statement saying that the Ethereum Foundation and he believe that Ethereum is not a security. So at this point, you have, Bitcoin, which even the SEC has said is not a security. Ethereum, which the CFTC has clearly said is not a security, which the Ethereum Foundation has stated, we do not believe we're a security. If any of these things go to court, I'm actually quite confident that those will get ruled as being commodities. I think this kind of lays the groundwork, really. And what I believe the courts will find is that Bitcoin and sufficiently decentralized layer 1 technologies are commodities. And then other things which behave like securities are not, fully decentralized will probably end up being securities, and that's probably a good thing to protect consumers. But more than anything, I think what's really clear is that we need, clear guidance, clear rules, and then everyone just, agrees to abide by those rules and move forward.
I was actually surprised to hear that you saw this, but some research out of Hyper. I don't know if you're familiar with them, but they
Hindenburg, yeah.
Hindenburg, that's right. Came out with their Big Short blog. He's interested, like Jack Dorsey. I'm a huge fan of his, so I'm totally biased. I haven't read the details of the report, but this is, I kind of wonder, like, when you have the tides shift, there are people that try to ride the zeitgeist. If they feel like their things are turning, it's just like people that perhaps don't get the benefit of the doubt that they used to, and so they can use it to their own advantage.
I think that like one of their big things is basically like they're trying to make Jack Dorsey look like some sort of like criminal mastermind because Cash App is being used to fund crime and all that sort of stuff. I'm like, listen, guys. You know what else is
US dollar?
Exactly. You know what else is used to fund crime around the world? It's called the US dollar. Like, I'm pretty sure there are more illicit transactions that occur in cash than happen on Cash App. And in fact, if you're doing fucking like crimes and soliciting Venmos or Cash Apps for those, like, good fucking luck. Have fun in jail. So,
leaving a nice paper trail there.
yeah, exactly. It's like you know what's awesome? Leaving a paper trail of the financial transactions of my crimes on the internet and or blockchain forever.
Yeah.
Great way to cover my tracks.
Yeah, exactly. It'd be like if I sent you a Venmo request or a Cash App request. It's like, Rob, for buying and selling. Yeah.
Why did I write that in the memo? These are for
man. These are for crimes. Crimes that we committed last night. Here's a picture in case you forgot.
Unreal. We'll see how that goes out. Matt, want to talk a little bit about your part of the world?
Of course. I love it. You know that.
Yeah. Like you got your model. Let's talk about the model.
So I guess we were going to cover a couple of like high-level points of data, not data, but more the analytics side. So once you've got your data, how do you think about writing models? And I guess it's more general because I've had a lot of different friends ask simple things like, how do you even know you've got the right model to start with? There's so many out there, all this kind of stuff. And the more I think about it, there are kind of like clear rules that you should be thinking about depending on what your problem set is. And so we were just going to cover some of those and have a bit of a chat about it in general.
I think the fun thing about having this podcast is it's more just like a free form like flow of thoughts that helps us get organized. And we spend a lot of time talking about macro, but at the end of the day, we are a quant trading shop. So both Matt and I, by training, are quants who make the majority of our money writing models versus like taking punts on macro events. So I think this is kind of a fun shift in conversation that I think that Matt is especially well qualified to handle.
Yeah, and so I think we kind of covered a couple of weeks back with Avi Pali, kind of data warehouses, databases, that kind of thing. What good data should look like. Kind of once you have that, we always think that the first step is, data is your first-class citizen. You as the business owner have to be prepared to sign that off. So that's kind of like step one. And I always like the thought that 99.90% isn't good enough when it comes to data and quality. Of course, there'll be errors and stuff. But as long as you factor those out with like good APIs, and we talked about that with Avi, then that's the key. And then as long as you have business that agree that you're happy with that end result and you sign it off, then it's like, okay, I got this data, what do I do with it next? And that's kind of where we're getting at now. That's what we want to talk about. So like, really, it really depends what you want to do. So most models that you might be looking at, and the simplest is going to be like supervised learning. And we were going to talk about alpha, but we'll make it a bit more general. Is either you may want to classify data, which is like a supervised learning problem, or you want to do a regression. So you kind of want to know, like, where's the price going to be versus is it up or down, which is more a binary decision. And you can label your data sets in different ways. You can come up with different ways to get these either binary results, or you could try and do something with a direction and a magnitude, like a regression. And that's kind of step one, like what you're trying to solve for. If you're trying to price a client, are you trying to work out exactly what spread to charge? Therefore, you should go with like a regression style model. Or are you just trying to work out, are they going to trade with you given some level of spread, which would be more trying to work out what the probability of them trading with you, which is more like a binary 0 or 1 type thing. And that's, again, so you have your data set, you decide how you want to characterize it, and then your choice is then to look at the data and make decisions around: are you missing values? Is it are you doing some kind of like clinical trial where you've got censored data where you don't actually see the final result? And it's funny because we used to have a lot of that in treasury electronic markets as well. Sometimes you charge a spread and you lose the trade, and so you don't actually see what that real answer was. Somebody else won the trade at a different spread to you. The only thing you know is that they were tighter than you. And these kind of models are like censored regression models. And so there's many different ways to kind of formulate the same thing depending on how much information you have. So I want to pause there and let internal ask questions, because they've probably covered a lot of different stuff.
Here's actually something that I think is probably...
I see Rob's head's like, what are you on about, Matt? He's censored regression.
Well, you talked a little bit about sort of like the difference between a regression and a classifier. So like a classic example of this would be, let's say I'm looking at the price of Bitcoin. I would use a regression to say, how much do I think Bitcoin's price will go up or down exactly? I mean, do I think it's going to go up by $100 or $20 or $0, right? A regression is going to give me an exact number of, given the variables that you're looking at, this is how much I think the price is going to go up or down. Versus a classifier would just say, yeah, this is just going to go up or it's going to go down. Or you might even say, like, I could create bins of something like, it's going to move very slightly between like my transaction costs, so we'll call that technically nothing happens, versus like something really big happens and something really small happens, and what's the probability it belongs in one of those bins. When I think of those, I always think of like there's a world of trade-offs with a regression versus a classifier. So maybe you can go really quickly into an idea of like, if I'm trying to decide for a problem, what do I gain by, for example, putting it in a classifier versus a regression? And what do I lose? And what are the trade-offs in terms of like how my model is and all sorts of stuff?
I mean, you nailed it up front, right? One gives you a magnitude, one and a direction, and one doesn't. So you will lose sensitivity to be able to say exactly where the price will be. And maybe that information is really important if it comes to price placement in the order book. You kind of want to know where to place orders. And so just knowing it's going up or down doesn't tell you how deep to be in the book, as an example. So you're giving up something. The benefit, though, a lot of times classifications are more stable. And that is because you kind of smooth out, instead of doing every single a continuous prediction, you kind of group larger chunks. So it can be easier to learn trends to say when a market's going up or down. But you're covering like either above zero or below zero, which is why you get a kind of generalization. But there are caveats there as well, because when you train models like this, you need to make sure that you have an even-ish balance of ups and downs. Otherwise, you have what's known as an imbalanced data set. And that then becomes more difficult, especially out of sample, to know what the kind of ground truth state is. So there's caveats for both. Regressions would tend to give... If you looked at the accuracy of a regression model, it would probably be much lower than the accuracy you'd get out of doing a classification, just up front, because of the nature of the problem set.
That's it. So that's an interesting one. I always think about... I remember reading a book.
Accuracy, by the way, is like a metric at which you look at. It's an objective function you're trying to solve for. So, for instance, classification to 0 or a 1 in this case by up or down. You can model that with a 0 or 1, like a binary value. And then your accuracy is you sum up the number of zeros and ones and divide by the total. So it's like how many times did you actually predict the 1 or the 0 over the times you got it wrong.
Yeah. So I always thought about that from the perspective of like a weatherman. So let's say you have a model that predicts the likelihood of rain. And there's always a little like art to these sciences as well, and selecting the metric, or like basically the cost of being right or wrong, actually can give you some bias in terms of like choose to do. So let's say, for example, you're a weatherman, and if you predict that there's going to be rain, and it doesn't rain, right? Then worst case scenario, people walk around with like an umbrella all day long that they don't use, and they're probably actually happy because they were expecting rain and it didn't rain. Versus if you're a weatherman and you predict that it's going to be sunny outside and it rains, then people could make plans to go to the beach or leave their umbrella and coat at home and then find themselves just like drenched and really, really angry and terrible. So in some ways, like the metrics that you choose to decide whether or not you're successful are even biased by the cost of being right or wrong. And so you can think about that also from like a trading perspective, which is sort of like, when you're trying to look at your data set, like Matt said, you want to understand, am I trying to predict an event that is rare? So case in point, like let's say you're trying to predict the probability of winning a trade, and you only have like 5% of all trades in your basket that you actually win because it's competitive. Well, your model can just say, we never win trades and be 95% accurate. And then you could go home and be like, fuck yes, I'm 95% accurate. This is the best thing in the entire world. I'm so good. But your model's not really done anything spectacular. All it learns is that, just to say no all the time, and then, it wins. But then what's the cost of that? Like, on the other hand, like if your model says we never win trades, then you never make any money and you'll never actually like put on risk. So I think like there is an art to the entire like process of modeling, in the sense that like you're going to model and the stats are going to do what the stats are going to do. But when you're formulating, right, what question do I want to solve? Part of this is saying, all right, am I trying to predict an absolute measure of this? Am I trying to predict, like, is this just going to go up or down? And in doing so, do I have like a balanced data set? Is accuracy a good fit, or do I need to find some other metric that kind of like takes into consideration both my true positives and false positives? And then when I do that, is there asymmetry in terms of like, if I'm right, is that better than being wrong? And what are the causes of doing that? And I think if you when you're trying to solve these questions, it's really good just to like whiteboard out exactly the problem you're trying to solve, what the first and second order effects are. And this is just purely beyond math. It's really just like logically walking through your problem and saying, like, right, what am I trying to solve for? And what are the costs of being right or wrong? What biases could I put in my model if I'm, thinking about it this way?
Yeah, agreed with a lot of that. The kind of core points for that topic, what Carlos said, like, yes, you could choose different losses, but you need to know what you're solving. Basically, that's it. And two of those examples we gave are like regression and classification. There's more. You might be doing clustering or something else. But in a nutshell, you kind of need to know exactly what you're solving for up front. And that really governs what kind of data you have. Like we mentioned, you could be missing certain values, and you need to take all of that business logic into your approach up front. I think what you said is good, like labeling it out on a board is actually the best way. And that kind of comes to another point on constraints that I was going to get to in a bit. Like, for example, a friend of mine models what interest rate you need to give to a client for them not to leave. It's kind of like churn, but making sure you charge enough. If the Fed's giving Fed funds is like 4.5%, nearly 5%. If your model's coming back showing -1%, probably something wrong there. So there's clearly like business constraints that you as a human can put in on said models, and so you need to know what's the kind of right modeling approach to do that. But before we kind of talk about models, we're going to say one other thing, are kind of in line with the data. So once you've kind of got your data, you've labeled it, or you've kind of agreed a formalism to tackle it, there are other things. What kind of data is it? Like, is it subject to regime changes, or is it a static data set? So the kind of static terms for those are like, is the error of my model going to change with time or across the distribution that I'm fitting? And that's known as like heteroscedastic errors, or is it something that's consistent? So I have two different windows of time, and the errors are exactly the same. That's known as homoscedastic. And the reason that's important is if you're trying to fit a model where the errors are changing, then your out of sample result could be very different. And this is why you need to think about, again, it comes back to the kind of model that you want to fit. Like we talked about regression, but then there's different kinds of regression models that you can use as well. So maybe something like...
So you mean
yeah, go ahead.
So like you mentioned, like the environment's changing, so your out of sample results might be different. So like you're talking about like a changing environment where you're running your model
I'll give you
in one environment, and then
a really good example. So particle collisions. Every day we measure that. A collision happens. You don't expect that data set to really change. There's no reason a measurement I made yesterday will be different from today. So you build up this massive corpus of data where it is effectively drawn from the same type of distribution, the distribution of physics that governs particle decays and interactions. And so that data set, in terms of along with time, if I measure it last week or this week, I'm just building it, I'm going to accrue more and more data. So your out of sample data is almost independent of where you draw it from. You have an in-sample period you could take tomorrow, you could have an in-sample period for a week, you could take the next week. Your errors are going to be pretty much the same because it's just based on the resolution of the detector, the experiment you built. Whereas in financial time series, banking crises happen, as we very well know, regime changes happen all the time. A model I fit last week may not be appropriate to the model tomorrow. And so you kind of need to be able to do a lot of post-ant analysis to see where things are out of line. And that's why I say the type of data set you have is important, and you need to understand that because, especially with financial data where you have a lot of serial autocorrelations, like when things are rallying, they tend to rally in quick succession. That means they follow the trend, like trend follow, whereas, and that's something that would lead to errors that are larger than you'd normally expect if it was just something that had like a normal distribution all the time.
Yeah,
and that's why people say finance is not normal, right? The details are not normal.
That's actually so. One thing that I was really curious to get your thoughts on. I'm not a quant, but I hear a lot of times people will talk about events that happen in the financial markets, and they are multi-sigma events that shouldn't happen once in like the lifetime of the universe, and they happen. But I hear that every 5 to 10 years. So I understand there's got to be a good explanation how these like super rare events can be happening all the time.
So
that's a question.
So the issue really is if you assume everything's normal. That's why. So when you talk about standard deviation moves, so like a 3 sigma move is 3 in 1,000. I think it's like 99.997%, which means it rarely will be wrong. If you follow a normal distribution, that you'll find something outside of 3 sigma. So in the physics community, we use that as evidence that something's happening. It's not gospel truth. 5 sigma, funnily enough, is the one for that. That's a discovery. But yeah, there are. If you follow a normal distribution, then those are the kind of probabilities that you're dealing with. When you get to 5 sigma, it's like 1 in a million or something like that, or maybe more than that. So these are really, really small probabilities. But again, it assumes normal. If you look at returns of a stock, you will not find that they are normal. So when they say it's like a 10 plus sigma move, these are like really, really low probability events, black swan events. They just mean they're massively in the tail of a normal distribution. But the normal distribution was a wrong distribution to compare them against in the first place.
Yeah. I'm going to go on a little bit of a rant here, which is anytime I hear anyone talk about finance and they jump to either an assumption that returns are normal or log normal, or they try and whip out like closed form mathematical solutions for things, I automatically assume that they're wrong and they're not managing their tail risks properly. Because if you think about the history of really like normal distributions and statistics in general, it is a mathematical approximation of the occurrence of events that exists in a closed form mathematical solution to make things easier before computers existed. And so a lot of these assumptions, just basically, it's like, if you remember your stats from college, especially if you went to a not a very good college like I did, and, like in the back of your stats book, there was a table where you could just like look up like a z-score and like a probability, and it would be like, oh, that's the probability that it happened. And then you just, pop it into a closed form solution. Like, it's just an easy way to do things if you don't have a computer that can handle a large corpus of data. And I think, one of my personal views that I've seen after, a decade of actually having worked with risk and finance is just like you said, Robert, like these risk events happen far more frequently than you would expect. And so, like, what we really get paid for is by looking at data and analyzing it in a non-lazy way. And the assumption of normality is probably the laziest thing that you can do from a like financial modeling perspective. It's just patently wrong. The data has shown it time and time and time and time and time again.
I mean, yeah, I'd agree with most of it, but I mean, there are times where you can have even a linear model that would assume normal errors and would get it right 40-50% of the time. But the problem with this,
then when you're wrong, you're really wrong.
Exactly, yeah. So great. So like half the time you're probably getting it pretty accurate, but the problem is, outside of those bounds is where it breaks down, and that's where you lose money. So
massively agree with you, and I think that's also part of like what you get paid for as a quant is to understand where your model fails. And as Matt said, understanding the role of regime changes and like knowing what will cause your model to break and when to just say, you know what, fuck it, model's not going to work today, turn it off.
Yeah, and I think that comes
half the battle.
That comes on a part of what I was going to mention for explainable AI and black boxes, which we'll get to. I don't know how much time we have left, but the other question is like, what model to use, right? There's so many different. I mean, there is a concept of there is no free lunch. This is a theorem. There is no free lunch. You could pick 2 or 3 different models and probably get really good results for each 3. And the question as to which one is right really depends on, like Carlos said, if you stress test them, on which one is better suited to the task at hand. Do you have speed considerations to apply? Like, if you need to be like a millisecond fast, can you really afford to run a model that is like a billion, like some of these NLP models, right, that are like billions of parameters long? Can you really afford to wait half a second or a second for them to compute to give you the result before something's already happened? So it depends on how high stakes does your decision, how quick do you need to be, how much do you need to explain the thing as well. Like, sometimes a linear model is good, there'll be flaws with it, but of course you'll be able to explain one-to-one exactly what happened. And so there's a question of how high stakes is your problem in the first place, because I think we may have talked about this before, maybe we did, I forget, but there's definitely been papers and literature showing where high stakes decisions were made by non-linear models that were black boxes, and they got it wrong, and it was to do with like jail sentence term. So people were coming up for parole in Texas, and they were using some gradient boosted tree models to say whether they should be released or not, with what probability they'll reoffend. And they couldn't explain all the factors because they're, trees that are sub-additive models, and it gets very complicated. Or actually, they also showed they could have used very simple tree-based models, had almost the exact same predictive power, yet you could say one-to-one, okay, it's this reason, that reason. And it goes to stuff I think we've talked about before with like credit card applications. There's some places where you'd want to know why a decision was made, and therefore sometimes a simpler model is good for that. Or you need to have a model that you can fully decompose and kind of at least know what it's sensitive to. And there's ways to do that as well. But there are.
Do that with a black box?
So yeah, there's a few techniques out there. So like Shapley values, which is like a game theoretic approach to waterfalling out relations from your feature set to your predictions to the actual target that you're trying to measure, and basically give a weight of how important each one of them is. Given you have the predictions and the actuals from the model, and that works reasonably well, but it doesn't tell you exactly and it makes some assumptions still. Like, I don't think it handles time series very well, if I'm honest. But yeah, there are a few other approaches as well. Or you could try and distill your model into something that's simpler as well. That's always an approach to use.
Like, as a rule of thumb, though, like if we're just going to say, let's say you've got a quant who's just started a grad program. It's their first time sitting on they're given some sort of like financial time series model they're going to do. What would be your advice in terms of what model to get started on, what to evaluate next, and then maybe what might be something that's just sort of like a, hey, try this if you want to, but, see how it works out type of situation?
I would always say start with the most simple model that you think satisfies your objective. So if it's a regression, like, first just view the data. That's always the first way to spot errors anyway, but just visualize it. And then second, try linear regression first off. You actually learn a lot just by seeing which features are important. And then after that, you can, go as crazy as you want. Like, I don't have a suggestion. There's so many different things to do there. And I wouldn't want to give people recommendations on what model to use. That's architecturally, that's IP. But yeah, you need to just make sure you have a good framework in order to make sure you haven't overfit. And that's key as well. Always take into account the sample size you have, and you want your in and out of sample errors to be in line. Like, I've asked so many people in interviews, okay, you've got a model that has an RM, root mean squared error, which is typical metric for a regression, and it has an in sample of 1 and an out of sample of 0.9, which is better. And some people will just say, because it's 0.9, that model is good, I can take it. And you're like, are you sure? And they haven't really considered the fact that you don't know how big the errors are on each of them. You don't know how much sample size you used in each. It could be it's 0.9 with a 0.00000 decimal, right? That's what your error is, like 0.1 precision. So it's basically 0.9 bang on. And then maybe the 1 was also bang on 1. And so these are a 20 sigma difference type of thing. And that then is a massive divergence in your in and out of sample measurement that you're trying to show. So I think there's stuff like that that's important that people sometimes don't look at, especially when it's like time series as well. So like, how you actually look at your in and out of sample need to be considered a bit differently. Yeah.
I think my general rule of thumb when I think about like that question really is, like you, I think it's probably the most important to start with the simplest model. And the simplest model is usually just a linear regression. I think that if you're starting
or linear
with
X, it could be whatever the objective is.
Yeah.
Linear something, yeah.
It's like some simple linear model where it's like, I know exactly what my features I'm putting in are. If I need to do anything more than that, I'm going to have to physically constrain or, physically, transform that model in some way. Like, it forces you to really understand the underlying data to get performance out of it. And once you get there, I think the important thing is just sort of like cascade and start getting more complex. And I think my general rule of thumb is if I'm going to switch from a linear model to a nonlinear model, I need the performance of that model to be exponentially better than a linear model, because I'm giving up in explainability and I'm giving up in speed in order to get that performance. And if I can't be sure that like that's going to be a significantly better step up, then why am I going to give up the explainability? Why am I going to give up the speed and the compute time and spend thousands of dollars more to train those models and more time when I'm trading to like do that? It's like, it just doesn't seem like a good trade-off unless you're really axed to tell people that you have got a nonlinear model in production so you can sound cool at a bar, which, by the way, no one is impressed at a bar if you tell them you have a nonlinear model. So I think just like really understanding that complexity is good. And Matt, you actually brought up a good point, which I think maybe you could talk a little bit about, which is how do you develop a good intuition for like building models and understanding things like goodness of fit and that sort of stuff? Because I think it's really easy for people to run through a couple like Kaggle things or read like a book on interview prep and like memorize. It's like, okay, good out of samples R square is good. That's fantastic. And then you walk in, you're like, yeah, like, it's just the answer. But like, I think it's rare for me when you come across somebody that's just got a solid intuition about how the models work, what the goodness, and like just sort of the art behind how to build that. So what would be your advice in terms of how to actually build that like good intuition about
I think that's
to deal with it?
That's why I think it's good to start with something really simple. Even if it's not as performant, at least you get a good understanding of what drives it. Now, that the caveat is you may have to build more features, which requires kind of business knowledge to get there. And we've had this in our world, is like our aim is to build models that don't require you to have all that knowledge to build the features in the first place, right? That's one of the things that we've done pretty well, and we think that scales well. But unfortunately, there just is a piece where you have to understand the data you've collected and also know how you might need to transform that from a business perspective. So you need to have the business knowledge, like what is really relevant, that drives it. And unfortunately, that's part of modeling. Like you kind of have to. You can't just be like, here's a data set. I mean, don't get me wrong. You can be given a data set. It happens, but it's so much more beneficial to know exactly what that data is, because that really helps you drive how you frame the model. And it should be a partnership with your quants and your business team, wherever this is. And you can extract value from using black box tools if you want, like that will work. But the key there is you need to really worry about the model drift. And that's the thing that I don't think people get really taught that much, is understanding when it drifts from expectation. And so there's a lot of interesting things you can look at with like model uncertainties. Models intrinsically know how well fit they are. Like you had a sample of 1 million data points, you fit a model to it, you get a statistical uncertainty from that information alone. And you can use that out of sample going forward. So there's some nice ways you can like actually use the fact that you know what the kind of statistical and potentially like systematic uncertainties might be when you go forward as well. And so there's those two pieces I think are never really talked about, but really looking at how your model performs out of sample is the key thing. Like ongoing evaluation of the model is really the most beneficial thing that you can do.
Yeah. And one thing that I think you do very well, just trust me, I've been in a world where I've had like an army of quants, like building trading models, and not a single goddamn one of them has actually watched the thing trade in live.
I mean, that's an issue. Yeah, you need to.
So in your mind, like, what do you think is the benefit of not only looking at it from a mathematical perspective, but also seeing the thing trade in production?
Well, you need to be end to end, and I think I'll make this the kind of last thing because of time on like final thoughts and comments in general. But so your work is never done. Like you may have fit a model and you've got really great performance and you think this is it. You'll always find something or a new architecture that's better. You could incrementally improve and make it better and better and better. But there might be minuscule improvements. So and going back to that question, is seeing it in live is so important because you get to see how it's used and its interaction with the rest of the system. And once you start to get a handle of what it does and how it's used, then you get a feeling for, okay, well, if I spend the next week tweaking this to get an extra X incremental improvement, what value does that really add? And I think that's the real benefit, is knowing when to say like good is good enough, because that's where you actually save money then for the business, because otherwise research projects are just open-ended. And I think that's a really good skill to have, is to know when you've got something that's good enough, and you see it interact in the broader thing that you're trying to build. And it often will identify other areas in which, okay, well, that's now the next focus type of thing.
That's awesome, man. Thank you. I find this fascinating. I think we should talk more about this on the show.
Yeah, I try to think there's some cool stuff with transformers that we could probably talk about a bit, and there's some. It's just hard to talk because you kind of like want demos and stuff. And I think we tried to do a demo a while ago, and it just didn't record right. So
yeah, we need to like for people whose job is to do like technology. Sometimes we're fucking shitty at it. No, but that being said, I think that being said, we do want to spend a little bit more time going into sort of the. Maybe not the direct IP of what we do, but the theory and the practice behind it. Because as Matt said, I think without having to give away IP, you can actually... I think that the biggest thing is developing an intuition and a mental model around how to structure your research and how to structure these things in a way that they're like useful from a business perspective. And it's not just like you doing open-ended science projects in perpetuity. Yeah. And if you can get that down, there's actually kind of a beauty about seeing an iterative process and watching it go from an idea to something that's like quite profitable, which in my mind is sort of like the real fun behind doing this, is just making those iterative steps and getting to the point where you can make a living off of it.
Love it. I'm looking forward to that.
Yeah.
Boys, gents, thank you so much for jumping on today. It was good to catch up, geek out a little bit. Have a great weekend.
Cheers, amigos.
Cheers, guys.
Peace.
See ya.
Bye.
Bye.